Welcome in, folks. It's a buy one, get three free here tonight. First video up here we're going to react to is this one talking about Tesla stock, Meta stock, and JP Morgan stock, and if these stocks are buy. Obviously, the multiples on these stocks have come down immensely. Second video up here, we're going to talk a little bit about PayPal and Block and react to this one on this gentleman's opinion on obviously Venmo, PayPal, which if you didn't know, Venmo is owned by PayPal, and the opportunity obviously in PayPal, which, you know, that stock has been one of the worst stocks, to be quite frank, of let's call it more large cap type companies. Like, absolutely incredible to follow there. Third video I want to react to is a short one here. Earnings will be under pressure for the next few quarters and most of 23. It's a very important subject that we have to discuss. And a last little clip we're going to react to here is Jeremy Siegel. If the Fed stopped looking at stale housing data, they'd realize inflation is over. Strong comments there, and I want to react to that and kind of give my opinion. Hope you guys enjoy. This is always 19,800 plus subscribers, I believe, on the channel now at this point, so I appreciate every single person that's subscribed to the channel. I'm glad you guys enjoy this as always. And also, just so you know, I put out a video basically last night inside the private stock group, and I'm actually going to make it so everybody has access to that if you'd like access to that. It's a 50-minute beast video that goes into Honest's Morgan Stanley newest conference. So if you want access to that, basically check out the pinned comment down there, and I can either send it over email or I can text you over the video. So yeah, I hope you guys enjoy that. Alrighty, let's get in this.
Delano Saporu, who's at New Street Advisors. He's also the founder and CEO there, also a CNBC contributor. Delano, thank you very much. Let's start it up with Tesla. I mean, this is pretty big. This is not a call on whether it's a buy or a sell from my standpoint, but it catches someone's eye when you say it was 100 times forward earnings and now it's 31 times. What does that say for you? Are you a buyer or a seller?
Hey, Dom. Yeah, that is attractive, and it does catch someone's eye, and it actually caught my eye at the beginning of the year when it was trading a lot less attractively. And now, if you look at that trade not been working so far, I think a part of that's the macro environment, part of that's reports of production cost, production cuts over in Shanghai. And so I think, you know, when I looked at it now, there's an opportunity when, you know, the valuation's gotten a lot better. If you look at actually the industry, we know that, you know, there's a push towards electric vehicles. We know that Tesla's the biggest brand name and the biggest market share in the U.S. in that area. And so, you know, even if that competition tends to pick up, I do think they'll bode well. I think, you know, expansion and production in Europe is getting better. So I like it here, and I liked it earlier. So I definitely like it here. And I think if you're holding, you can hold. And if there's opportunities in the next couple of months, there might be to actually buy here as well.
I just keep looking.
Yeah, so this gentleman basically says Tesla's a buy. I'm interested to hear what he has to say about Meta and JPM. And my opinion is Tesla stock a buy. My opinion on that is it's a buy if you have a long-term perspective. If you were expecting to make short-term money in Tesla, I just don't think it's that sort of stock over this next 12 months. I think they're going to have a rough next year in terms of analysts bringing down numbers, analysts bringing down either like buy ratings, sell ratings, you know, hold ratings, those sorts of things, and kind of bringing all those down, right? And I just think it's going to be also a cloud of, obviously we got the Elon drama still going on with Twitter. That's likely going to go into at least part of 2023, if not the whole year. We'll see, right? And then on top of that, you have serious worries about the economy and that getting worse as 2023 goes along, which obviously would hurt Tesla's numbers. Then on top of that, you got Cybertruck, which is coming, and that's exciting that Cybertruck's coming. But the problem is, we know when Tesla goes to ramp a new vehicle, especially a brand new vehicle like that, they usually take big losses in that first quarter or two as they're ramping, right? So they're going to start, you know, trying to ramp a Cybertruck toward the end of the year. That's likely going to hurt profitability. So you have so many things kind of working against Tesla in the short term that the way I would look at Tesla in 2023 is if you're a real believer of where Tesla's going over the coming years in terms of how many vehicles they're going to sell, in terms of where their revenues are going, their net income's going, and all those sorts of things, right? You have to just view 23 as an entire buy year, essentially, and just be prepared that you could be buying at, you know, let's say 160, but you might also be buying at 90 bucks. And you have to be mentally prepared for that, okay? It doesn't mean it's going to happen. Just be mentally prepared for that to be a potential situation, okay?
That 29.83 forward PA used to be over 100. It's just remarkable. All right, Delano, what about Meta, which has long been kind of a value stock, if you want to call it that, but it's pretty much near its cheapest level ever now, 17 times forward earnings estimates.
At the lows, it was like 14 when it was like trading at $18 something a share. Maybe it was, I think it actually got down to like 12. I'm thinking about it now. That's crazy.
Yes, definitely around its cheapest level. 7 times forward earnings. Hasn't done well year to date. In the last, you know, month or two, it's bounced.
Sure enough, yeah, right there it was right around 12 forward P for Meta. So that's why I say when some stocks get into silly valuation territories, like, you know, You just have to be mentally prepared. Is it impossible for Tesla to go under $100? No, it's not. And, would Tesla be trading at silly valuations? Yes. But at the end of the day, like this sort of market we're in, it can price stocks in very silly territory. It's just the way it is.
Little bit, and you saw that because of a lot of the restructuring that's been happening at Meta, and investors did like that. I think, they still have headwinds when it comes to competition and addressing, the privacy changes and seeing if commercial ad spend will come back on the e-commerce side. But, overall, this is a hold for me. I think if you look at it just from, the top down, you just have an area where they have the biggest, family of apps and over 4 billion users that are still on the platform. So I think ad spend comes back in the late half of 2023. And we see a company that has been spitting out profits rather well over, a decade. And so I think that continues, but there's some headwinds that they'll have to get through first.
All right. Yeah, so my opinion on Meta is absolutely a buy. Now, here's something else I will tell you, is Meta is likely going to become my number one biggest investment. I do think they're going to be in a battle. Actually, not with Tesla, but I think they're going to be in a battle with Honest. I think if Honest really shows out in 2023 and improves their margins dramatically and their business dramatically in 23, then because I own over 100,000 shares of Honest, there's a good possibility that Honest could overtake all positions in terms of sizing, because that's a very small company and it doesn't take a lot to kind of get that one moving up if margins start going in the right direction. Revenue and profitability all emerge for that company. So I do look at Meta as a complete buy for 23, because regardless of what Meta is trading at, $100, $120, $140, $160, $180, $200, everything's a buy. Everything under 200 is a buy with Meta. So it's just like the cheaper it is, obviously, the more shares you can get. But that's kind of my view on that one. It's a buy. It's not a hold. It's a buy, flat out. Let's hear what he has to say about JP Morgan.
So that's the call.
Which, by the way, all three of these stocks I own. It's actually kind of funny. Tesla and Meta are my two biggest positions in the public account. And JPM is a position I have in my dividends only account. So all three of these I personally own.
Meta, I also want to take the final name here. It's JP Morgan Chase Delano, now trading at a forward price to earnings ratio of 10 as the financial sector continues to suffer this year. Now, I will point out that at a discount valuation from an earnings basis, many traders and investors look towards book value. This still does trade at a premium.
Banks, a lot of folks look at book value, much more so than a Tesla or Meta. People don't even care about Tesla or Meta's book value, to be honest. Banks, it's a very different situation.
Book more so than others. It trades at about 1.4 times book. For comparison, Bank of America trades right at book value. So is JP Morgan of value at this level?
I think, looking at the price action, relative obviously the tech names we mentioned, it's held up a little bit better. I think, one of the areas that I like is the consumer banking side. When you're talking about obviously the interest rate environment we're in right now, a lot of it, could be a benefit for the banks on the consumer banking side if they have obviously higher loans that they're getting higher interest on. And also if you look at the lending and the deposits increase on the side for JPM, that's the things that I like. I know that the capital markets has dried up and M&A has kind of dried up, but the banks, if you look at JPM and Bank of America, they've done well on the consumer banking side, and that's the thing that's attractive here. Whether it's a better valuation, maybe not as crazy as more attractive as the other valuations, but I still think it's one that you could potentially buy if you're looking to hold on to something that could potentially have a tailwind going into 2023 based on the interest rates that we're at right now.
A lot of traders out there point.
So in my opinion of JP Morgan stock, okay, and as somebody that owns a stock, I got to talk a little negative about it for a moment here, okay? Because what I believe in terms of JP Morgan, if this stock's a buy or not, right, is I look at this company and I see a company that does look very attractive valuation-wise. But I also, and this is a big warning, is I do believe it is a potential value trap. If we're talking about the economy is going to weaken quite considerably as 2023 goes along, right? Which we don't know if that's a for sure thing, right? But let's imagine that scenario plays out. In that scenario, JP Morgan goes substantially lower. And JP Morgan would likely have some sort of major loan losses, maybe some problems with their credit card business or their consumer banking business. Like, there's going to be some problems there. If we're talking about the economy kind of starts to fall off the rails, there will be issues there with JP Morgan. There's just no doubt about it, right? Not the type of issues that is like, oh my gosh, they're going to zero, like not those type of things, but there would be issues that would bring that stock down quite considerably, right? And that's something I worry about in regards to all the banks, not just JP Morgan, okay? And they're the most well-run of the bunch, but still, the bottom line is if the economy got ugly, JP Morgan will get hit. And there will be issues there. There will be all of a sudden losses that nobody saw coming. And it's all of a sudden like JP Morgan's taking a $2 billion impairment charge on blah, blah, blah. And like everybody's like, what? How did this happen, right? That's what happens when you're in a major down cycle. So JP Morgan kind of looks cheap, but it might actually be a value trap, okay? And that's what I'll say about that, even though I do own it in my dividends-only portfolio, okay? Next one up here, let's talk a little bit about PayPal. Let's talk a little bit about Block and FinTech.
It's behind those calls, and it's Block that you like here, Kevin. Why is that? Welcome.
Thank you, Kelly. Block stands out to us because it's been able to generate significant revenue growth and potentially gross profit growth, particularly within Cash App and then also within their Square franchise. Block's been able to produce, roughly 126% growth within subscription-based revenue over the last couple of years. And we expect them to be on pace for over 40% growth over the next year. And with that revenue growth comes significant operating leverage that I think the market is not appreciating. These stocks have been under a lot of pressure, just given, Fed interest rate increases and other things. But I think that turns around as we move through the next 6 to 12 months.
Should they rename it back to Square? Every time I see Block, I think, crypto is kind of collapsed. Yeah, go ahead.
The ticker is SQ, so definitely get a few of those.
Yeah, true. All right, let's talk about
I don't know if Jack Dorsey's listening to what I'm saying.
Of course he is. Of course he is. Let's move on and talk about PayPal. And of course, it's all important Venmo app, but kind of the sister story in many cases of what we were just discussing, but you're just neutral there. Why? Why don't you think that?
So Square first, let's talk about that. Block. I do view their stock as a buy. I don't personally own it. I do think it's a stock that will do well over the next 5 years. I think it's still going to be kind of tougher sledding there for this next kind of bit of time here. But long term, it's a great company. Cash App's usually the #1 ranked finance-related app in the United States of America. Usually number 2 and number 3 are PayPal and Venmo, right? Which are both owned, obviously, by PayPal. So that's very powerful. Plus, they got their Square traditional business, right? And I think they are positioned to build out successfully in crypto over time in terms of maybe crypto payments platform and things like that, right? Which I understand crypto's been through an awful cycle the last year, right? But it's not like crypto's dead forever, right? There will be a resurgence and there will be some folks that want to use that as like a payments platform, things like that. And Square's positioned to potentially be that sort of company over time, essentially, okay? So I do like Square. Don't personally own it, but I do like the stock for a long-term perspective.
Prospects look brighter into next year.
I mean, they definitely have some extremely valuable customers, especially within Venmo. And I think longer term, the ability for them to monetize that customer base and get those customers to really use that for transactions with merchants as opposed to peer-to-peer money transfers, I think is really the key to what's going to happen with PayPal over the next, I would say, 3 to 5 years. And monetizing Venmo is extremely important. However, what we're seeing is the revenue growth from this company has been slowing, especially coming out of the pandemic, which is making it tougher for them to generate operating leverage. In fact, we're seeing operating margins go down. And so we think the stock garners a lower multiple relative to Block. And
first off, could be a big cut coming in employee count for PayPal and Venmo in 2023. Not a for sure thing, but could be. Let's just keep that in mind.
For where it sits today, it's in a tougher spot. But we'll caveat it and say there is a lot of potential that if they are able to execute, it could be a very strong performance.
Sure. And finally, AMEX, just a quick word here. What would get you more excited about the stock?
PayPal has had a history of getting the job done and doing great. Yeah, it's been an awful past year for PayPal stock, right? But the track record of that company is very impressive. And what they've done with PayPal and Venmo over time has been very, very impressive. So, I think the valuation is way too low on PayPal right now. I do think the company is a buy in my personal opinion, and I do view PayPal as a maybe a little bit of a less reward and also less risk than like a Square stock, for instance. I like them both, but I just like PayPal better from a risk reward standpoint, which, as we know over the past year, the risk component of judging companies has become more important than ever, right?
Initiated it with just a neutral.
AMEX is a great company. They have one of the best customer bases within credit cards or within payments overall. It is incredibly resilient through recessions. It's more expensive relative to peers. It's outperformed relative to peers over the last year. It's just it's a more expensive stock relative to what I see out there today. So this is more of a relative call more than anything else. I think if we have a soft landing with the economy and the Fed's, and we start to see CPI slow, like maybe we saw this morning, on the other side, American Express could do pretty well because spending is going to remain elevated. We expect spending to slow down over the next year, which I think is going to put a headwind on the revenue side.
Yeah, so my perspective on American Express, exactly like his, I would call myself neutral, if you want to call somebody like that, right? I wouldn't say I'm necessarily bullish on American Express. I wouldn't say I'm bearish on that. It's just kind of like, it's a good company. I shouldn't say good company. It's a great company. Valuation's not cheap by any stretch of the imagination when it comes to American Express. So that's why I kind of put it in that neutral category. Next one up here, important subject. Earnings will be under pressure for the next few quarters in most of 23. This is something the market has not priced in yet. Is any significant weakness in earnings with companies? And that's why this is such an important subject and why I wanted to hear this gentleman's opinion and react to this, because the bottom line is, the fact is, in regards to this, the market has come down valuation-wise with stocks, but it really hasn't brought the stocks down from the perspective of earnings falling off, right? It's been more just kind of a valuation correction so far. Now in 23, we could get an earnings drop in the market, which is actually likely even more substantial, especially for a lot of the S&P 500 type companies, the Dow type companies. Let's jump into this.
Thanks for having me, Kelly.
So do you think that's what the market is realizing? Sort of the, yay, CPI is decelerating, oh wait, maybe decelerating us right into a recession kind of thing?
I think there are a bunch of things going on. One, certainly some nervousness about Chair Powell's comments tomorrow afternoon. And then the reality that earnings are going to be under pressure over the next few quarters and for most of 2023, quite frankly.
So when we say earnings are under pressure for 2023, what do you think the market currently has priced in and what do you foresee?
Well, the bottoms-up numbers are a little bit scary. It's 235 on the S&P 500 versus 220 this year. So that's a high single-digit gain. But the tops-down strategists are closer to 200, which implies a decline in earnings next year. My guess is that earnings estimates are going to be revised downward when we get to fourth quarter earnings in late January and early February.
Yeah, that's going to be another tough slog then for the market to swallow. So when we say you still see opportunities here and still are in stocks, I mean, why? Why not just wait it out, pick everything up a little bit more cheaply?
We actually have a blog out on that today on AB's Context blog site. But I think companies that have inelastic demand, have real secular growth, have pricing power, have cost-cutting opportunities, those are the kind of companies that are going to prosper in 2023. And I don't think that's...
To answer very simply, I'd put it like this. If she asked me that question, right, I'd say, to start playing that timing game of like, oh, let me get out because, earnings might get worse in 23. It's like, okay, you get out, and then what if that doesn't come to fruition? What if that doesn't happen, right? Are you going to base your investment decisions about what might happen in the macroeconomic landscape, right? Or because you could certainly be wrong. In macroeconomics, people are wrong all the time, right? So you're going to get all out of your stocks. And then let's say you are right. When do you get back in? And then once you get back in, what if things continue to deteriorate? Do you stay in? Do you get back out and be like, oh crap, man, things are actually getting way worse than I expected. I need to get back out. And then you get back in, and then you're playing a whole trading game. Now you're not investing at that point. You're just trading in and out and trying to time things out. And as every great investor has ever told us throughout time, don't time the dang market, right? And it sounds attractive, and in hindsight, it looks perfect. But in reality, it doesn't work, and it just sets you up in very, very bad, poor habits.
Fully discounted in a lot of the names that are going to be those winners.
Yeah, but all that said, and you have a name like TJX, for instance, the parent company of TJ Maxx. I give CDW, Charles Schwab. I mean, each one of those I could go through a litany of reasons. For Schwab, maybe it's more of, the financial market story that's a headwind. For TJX, if there's a recession, you would have to expect to get a price reset below where we are now or not.
Well, I think the interesting thing about a TJX is as their customer starts looking for value, leaves the department stores and goes to an off-price retailer, TJX is the best. And oh, by the way, on the buy side, the goods that they're able to buy right now, phenomenal deals, which means that their margins are going to go up next year, not down. With Schwab, the opportunity from the net interest margin reset. So everything that's happened this year with rates going up, Schwab's going to benefit from that in 23, 24, and even 2025. So a great tailwind, which is why we like it, even with a tougher market. Rates, they're far more rate sensitive than market sensitive.
Yeah, I appreciate those thoughts. You know, TJX and obviously Charles Schwab, not really my cup of tea as far as stocks go, but I like how he was very prepared for that question, as he should be, right? Next one up here, Jeremy Siegel. If the Fed stopped looking at stale housing data, they realize inflation is over. All right, Jeremy Siegel, what are we talking about here?
Does that remain your argument? I'm wondering, what do you make of what was a very good CPI for the most part, and what was a very good reaction in the stock market, which doesn't look so much anymore?
It almost looked like someone had the CPI beforehand, the way the futures were going up. And, you buy on the news and so on.
Yeah, a friend told me that I guess the Qs were up over 5%. Pre-market, that's insanity.
On what happened here. I think it was very good news, and I think it's very much what I've been saying to you and others for the last 2 or 3 months. I would like to comment on that service portion. Listen, the housing at plus 0.6% is a nonsensical number. Is actually a bogus number, if you want to know my opinion. If we get any rental index, apartment list, Zillow, if we get any housing index, K-Show, or the federal index, those are going down. And since housing is almost 40% of core inflation, they said it was 0.6, and that was 40%. If it's going down, tell me what core inflation is. I'll tell you what it is. It's negative. It's negative now. It was negative next month. It will be negative next month, and it's actually been negative for the last 2 months. So
100%. 100%. Agree 100%.
The Fed stops looking at stale housing data, and I don't know why they don't. They would actually realize that inflation is, as I said a month ago, over. Now, whether they recognize that, I don't really know. I already think they're in overly restrictive territory. I think this should be the last hike. I actually think that they will see data early next year that will prompt them not to do any increases. And as Josh said, the next discussion of the Fed is, when should we lower rates? Now, the dot plot tomorrow won't show that. The dot plot will show they'll do 50. It'll show another 25 or 50 or 25 going on and holding for next year. Mm-hmm. But let's be honest. Does the Fed know what it's going to do next year?
No.
Not at all.
No.
There is no evidence that the Fed's dot plot has any predictive power on what they're going to do.
Yeah, good recap there, Jeremy Siegel. 100% in agreement. And Fed lagged the other way. They're going to lag this way as well. It's a story. It is what it is. Let's just call it that. Hope you guys enjoyed today's video. As always, once again, if you want that honest video for free, I can send it over via email or text it over if you're looking for that. Did it last night, so it's pretty awesome. Much love as always, and have a great day.